Sheila, it's great to have you. Let me take you back a week because it's almost exactly a week ago. You've got Silicon Valley Bank on the brink of failure, or at least depositors just getting out en masse. Signature Bank, First Republic, all of which we might have expected might not have been in a position to open given the deposit runs and then the prospect of that moving to other regional banks. So what would you have done had you been in your old position as chair of the FDIC?
Well, I would not have declared Silicon Valley and Signature systemic. These are combined assets, $300 billion in a $23 trillion banking system. I don't think there would have been any systemic ramifications from putting a slight haircut on the uninsured depositors, which were those who were bailed out. If regulators were seeing a truly systemic problem with uninsured deposit withdrawals, then they should have, and I still continue to say, they should go to Congress and get approval to provide a blanket backstop against uninsured depositors at all banks. If you do these one-offs, you say, okay, we're going to bail out this one, or we're going to bail out that one, but then all the others are out there, well, what about us? It creates uncertainty, and the ones that do not get the bailout are under more pressure, as we were seeing with First Republic. You know, their uninsured depositors are uncertain. Are they going to get a systemic determination? So I think we've lost a lot of potentially. I think the optics around, especially bailing out Silicon Valley Bank's uninsured depositors, will hold Silicon Valley venture capitalists and their portfolio companies that they are. I think those are terrible. It would have been a small haircut, I think, just by announcing they were going to do an advanced dividend to the uninsured of 70 or 80 cents. Could have done a lot to calm the situation, explain to people this is an unusual situation, explain to people how the FDIC process works. We handled nearly 400 failures when I chaired the FDIC without a systemic risk determination. So that is what I would have done. And if they're seeing, I haven't seen it, though, I think the risk of this was that by saying it was systemic, these relatively small banks, people are now nervous. Well, what's going on? What's going on in the broader system? So if it starts to get out of hand, they need to go to Congress and get, blanket authority to provide protections for all bank uninsured depositors, not just a handpicked few.
Yeah, although, Sheila, it remains very much uncertain as to whether Congress would give that blanket authority. There's a lot of divided opinion here on to this very point in terms of the idea of moral hazard that would come from insuring all deposits.
Yeah. Well, we did it during the great financial crisis. It would be temporary. You should charge banks an extra premium for providing the coverage. Look, I don't like bailouts of any sort, so I would only do this if they're seeing, true systemic problems with uninsured deposit runs. There's a lot you can do with appropriate communication, telling people, where they can get information about their bank, assuring them that most banks, and I think the vast majority of banks, including regional banks, are perfectly fine. But if there's truly a problem, if they're starting to see significant runs, if the chair of the FDIC, the Fed, the president, and Secretary of the Treasury go to Congress and say, we need this authority, I think they would get it. There's a fast track procedure for it. And even if they don't, I don't think that would happen. I don't think Congress would take the chance of saying no and catalyzing a potentially worse situation. So I've talked to a lot of people on the Hill. They've been reaching out to me. I do think there would be bipartisan support for it. And if they present a unified front, I think they could get it done.
Do you think that's what ultimately is going to happen here?
Well, it may. Again, I don't like bailouts of any kind, but you never have good options, so it's the least bad option. And yeah, I think it may well come to that. This First Republic thing, it's disappointing. I thought that would give First Republic some significant time to get itself straightened out, but there's a lot of pressure again on the bank even today. So, I'm glad at least they didn't use government support. Private banks came in to try to stabilize it, but it's not clear it's working. And, the problem is with this is fear becomes the major issue. Fear. People need to understand how a bank works. It's a classic Jimmy Stewart problem. When you put a deposit in a bank, they don't lock it up in a safe. They keep a lot in reserve to make sure they have enough liquidity, cash, for deposit withdrawals. But most of it, they make loans, they make investments, and whatever returns they make on that, that's how they get their profit. And then they pay some of that in interest to the depositors. That's how it works. If you rush into a bank, everybody at once, this is what happened with Silicon Valley, and pull all your money out, you're going to force an otherwise healthy bank to fail. And that could be a very, very serious problem for our financial system. So that is really the dynamic the regulators have to avoid at all costs.